Today in this video, we would learn what is short selling. We are all familiar with the normal strategy of buying shares at a lower price and selling them at a higher price to earn profit. This is the general transaction to buy at a lower price in the market and expect to sell at a higher price, thus collecting a profit. This trend of market is known as the bullish run of the market. In bullish run we expect the market to move up, or to run in a positive direction. Now market can't always run a positive direction or be bullish. Market needs to have some correction or fall down, which is called the bearish trend of the market. Now what do the traders do when they know that the market should fall and be bearish? Traders won't like to sit, wait and watch for the market to fall before they buy their stocks before the market makes a up move. Here comes the short selling strategy. Short selling helps the traders to trade and earn even in a falling market, thus making the market trade possible both ways, when the market is bullish and even when the market is bearish. Short selling is the method of selling first and then buying it back to complete the transaction. It is selling something which you don't have. Short selling is a financial technique which is used by investors to profit from a decline in the price of a security, such as a stock or a bond. In short selling, the investor borrows the security from another investor and sells it on the open market, hoping to buy it back later at a lower price. When the price falls, the investor buys back the security and returns it to the lender, pocketing the difference as profit. Short selling is a powerful tool for investors and traders, letting them trade and make money in both bullish and bearish markets. Short selling also carries a significant risk, as the potential for losses is unlimited. If the price of the security increases instead of falling, the short seller must buy it back at a higher price, leading to a loss. The short selling method begins when the investor identifies a security which they believe is overvalued and likely to decline in price. The investor then borrows the security from another investor, typically a broker, who holds the security in their account. The broker typically lends the security to the short seller in exchange for a fee, which can be either a flat rate or a percentage of the value of the security. After short seller has borrowed the security, they sell it on the open market. The short seller now has a short position in the security, which means that they have an obligation to buy it back and return it to the lender. The short seller expects that the price of the security will fall, thus letting them to buy it back at a lower price and pocket the difference as profit. If the price of the security does fall, the short seller buys it back and returns it to the lender, thus earning a profit. The profit is equal to the difference between the price at which the security was sold and the price at which it was bought back. On the other hand, if the price of the security increases instead of falling, the short seller has to buy it back at a higher price, leading to a loss. The potential for loss is unlimited in short selling, as the price of the security can continue to rise to an infinite limit. Short selling is a controversial technique, and some believe that it has the potential to destabilize the financial markets. Critics argue that short selling can create a self-fulfilling prophecy, as the selling pressure created by short sellers can push the price of a security down, leading to further short selling and exacerbating the decline. However, proponents of short selling argue that it provides valuable liquidity to the markets, allowing investors to hedge their portfolios against losses. They also point out that short selling helps to uncover fraud and mismanagement, as short sellers are often the first to detect problems with a company. In order to mitigate the potential for market instability, many countries have implemented regulations governing short selling. These regulations can include restrictions on the percentage of a company's shares that can be shorted, restrictions on the timing of short selling, and requirements to disclose short positions. Short selling is a powerful financial technique that can be used by investors to profit from a decline in the price of a security. Short selling is the weapon of the bearish market. However, it also carries a significant amount of risk, as the potential for losses is unlimited. Despite the controversy surrounding short selling, it is an important tool for investors and provides valuable liquidity to the financial markets.